Insurance is supposed to protect you from catastrophic financial loss. That's it. It's not an investment. It's not a wealth building tool. It's a cost you pay to transfer risk. Hello, friends. This is Tyler Gardner welcoming you to another episode of your Money Guide on the Side, where it is my job to simplify what seems complex, add nuance to what seems simple, and learn from and alongside some of the brightest minds in money, finance, and investing. So let's get started and get you one step closer to where you need to be. Welcome back, my friends. I'm Tyler Gardner, former financial advisor, portfolio manager, and the guy who's about to spend the next 40 minutes convincing you that most of what the insurance industry sells is somewhere between unnecessary and borderline predatory. Oh yeah, I'm starting with some fire today. Today we're going to talk about insurance. All of it. The good stuff, the bad stuff, and the stuff that is so egregiously terrible that I'm genuinely baffled it's still legal. I'm not kidding. Now, before we dive in, quick and familiar favor and ask if this show has been helpful to you, if you've learned something, avoided a financial mistake, or just appreciated that someone's willing to call out an entire industry for being slightly sketchy, please consider leaving a review on Apple Podcasts or Spotify. It helps more people find the show. And honestly, given what we're about to discuss, the insurance lobby probably isn't going to be thrilled with me, so your support matters more than you might know, and I appreciate it greatly. All right, let's get into it. A few weeks ago, you may recall I did an episode on the real financial order of operations. Basically, where your money should go, and in what order. And step 4, before even establishing an emergency fund, was to get term insurance and disability insurance if anyone does, in fact, depend on your income. That's it. Term life. Not whole life, not universal life, not indexed universal life, not variable life, just plain, boring, and relatively cheap term life insurance. And I got a lot of questions about that step. People asking, but Tyler, what about whole life? My financial advisor says it's a great investment. I've been told it's a great wealth building tool. What about building cash value? And what about tax-free growth? Okay, I need to take a breath before getting into this episode, so I do my best to stay polite and diplomatic, because today we're going to unpack all of it. We're going to talk about what insurance actually is, why you need some of it, and why you should run screaming from most of what the industry tries to sell you. And I'll even include some all-too-real anecdotes so you can see this isn't just my opinion, and this is what goes on behind the scenes. So here's the roadmap for today's episode. We'll start by talking about what is insurance and why we even need it. Then we'll move on to whole life insurance and why it's a scam dressed up in a suit. Then we'll move on to the hybrid models, the IULs and variable life policies. And if you have to go right now, just know they're equally terrible, full stop. Then we'll move on to annuities. Actually can be useful for some people. I know, surprise. Then we'll move on to long-term care insurance, increasingly rare but worth considering. And finally, we'll move on to talking about health savings accounts, the equivalent of an insurance product that you should absolutely be maxing out if you can and are eligible. So, let's start, as most good stories do, at the beginning. Number 1, what is insurance and why do we need it? Okay, as always, we're going to start with the 1.0 before moving on to the 2.0. Let's define insurance, because I've found that many people buy it, or at least are intrigued by it, without ever really understanding what it is at its core. Insurance is a contract where you pay a company a premium, aka money, and in exchange, they agree to cover you if something bad happens. You're transferring risk to someone else for a price. That's it. That's insurance. You pay someone to take on the downside risk for you. And because those companies can then do what's called pool that risk by insuring lots of people across a space, it can be a great deal for them. And ultimately, it could be a great deal for you. Let's think about it this way. You pay $50 a month for car insurance because you don't want to be on the hook for a $30,000 accident. You pay $100 a month for homeowners insurance because you don't want to lose your house to a fire and have to rebuild it with your own money. Not to mention you wouldn't have gotten the mortgage in the first place. And you pay for health insurance because a hospital stay can actually bankrupt you today. Insurance exists to protect you from catastrophic financial loss, not inconveniences, not minor expenses, catastrophic loss. And here's the key that we'll get out of the way early, and I'll repeat it later. Insurance is not investing. It's a cost, a necessary cost, sure, but a cost nonetheless. The insurance company is not your friend. They're making a bet that you will pay them more in premiums than they will ever have to pay out to you in claims. That's why they will almost always challenge when it comes time to make claims. The less they pay out, the more they make. And statistically, insurance companies win. No surprise there. That's how they stay in business. So when you buy insurance, you're essentially saying, I am willing to pay a small, predictable amount each month to avoid the risk of a large, unpredictable loss somewhere down the road. And that's smart. That's what insurance is for. But here's where it gets a little tricky. The insurance industry has spent decades convincing people that insurance can also be an investment or a wealth building tool, that you could pay premiums and build wealth at the same time. So let me tear down that wonderful vision of a castle in the sky now before you fall victim to this absurd script. No, you can't. At least not efficiently. So let's start by talking about the types of insurance you actually need. You're going to need term life insurance. If anyone depends on your income, spouse, kids, aging parents, you need term life insurance. Term life is simple, which I love. You pay a premium, and if you die within the term, usually 10, 20, or 30 years, your beneficiaries get a payout. If you don't die, the policy expires, and you get nothing. See how easy that was to explain? That means it's usually a good product. Healthy 35-year-old, a 20-year term policy with a $500,000 death benefit might cost about $30 to $50 a month. That's it. Pretty cheap, straightforward, and it does exactly what it's supposed to do. Now, just imagine putting that $30 to $50 in an emergency fund instead and expecting that will cover your family in the event that something truly bad happens. It won't, not even close. So that's why I put term and disability way ahead on my financial order of operations than building out a cash account. You're also going to need disability insurance. This one's underrated. Statistically, you're way more likely to become disabled during your working years than you are to die. And if you can't work, odds are you can't earn. And if you can't earn, your financial plan falls apart. Long-term disability insurance replaces 60 to 70% of your income if you become unable to work. And many employers offer it, but if they don't, you might want to consider buying this one for yourself. Go check with your HR team today to see. Next, you need health insurance. Obviously, don't be silly. Get health insurance. I had one uninsured visit in my life to an ER, and holy moly, did that open my eyes to how absurd the prices of healthcare are these days. Get health insurance. Finally, homeowners and auto insurance. Required by law or by your mortgage lender, and for good reason. Catastrophic losses, you need coverage. And that's it. That's the list of insurance most people actually need. So again, if you need to run and stop listening, just know there's your value add this week on the positive side. Now, for those who are staying, and because I know how many people want to hear the negative takes as well, and some truth bombs that you might not have heard yet, let's talk about the stuff you don't need. This episode is brought to you by Gelt. Here's a question I bet you've never asked yourself. What's the difference between a tax preparer and a tax strategist? A tax preparer shows up once a year, collects your documents, fills out forms, and tells you what you owe. That's it. Transaction complete. A tax strategist, they're calling you in October, saying, hey, you're about to cross into a higher bracket. Let's talk about accelerating some expenses. They're texting you in December. Don't take that distribution yet. Let's run the numbers first. If you're a small business owner or a high earner, that distinction can be worth tens of thousands of dollars a year. Gelt isn't your dad's CPA firm. They're proactive. They reach out throughout the year with actual strategy, not just compliance. Should you buy that equipment before year end? Should you pay yourself a bonus or leave it in the business? What's your estimated payment schedule look like to avoid penalties? And here's what surprised me. Their platform doesn't feel like tax software from 1997. It's actually organized, intuitive, and built for people who run businesses, not accountants who love pivot tables. If you've been avoiding finding a real tax partner because you assume it's expensive or complicated, stop. Gelt will save you money and simplify your life, and they'll give you a free consultation to see if it's the right fit. Sign up by January 31st, and they'll help you calculate your taxes due by April 15th. No surprises, no last-minute scrambling, just a clear plan. Head to joingelt.com/Tyler. That's joingelt.com/Tyler. This episode is brought to you by Copilot Money. I don't usually get genuinely excited about financial apps. Most of them are either overly complicated or cartoonishly simple, but Copilot Money is different enough that I told 3 of my closest friends about it unprompted within the first few weeks of using it. All 3 work in finance, all 3 signed up. All 3 came back to tell me they love it. That doesn't happen often with this crowd. What caught my attention is how Copilot Money manages to be both powerful and calm at the same time. It automatically tracks your spending, net worth, savings goals, budgets, and investments in one beautifully designed dashboard that doesn't make you feel like you're piloting a spaceship. It won an Apple Editor's Choice Award. The only personal finance app to do so, was a finalist for the Apple Design Awards, and has a 4.8-star rating from over 25,000 reviews, which tells you that people who actually use it tend to stick around. Copilot Money automatically categorizes transactions so you're not spending Sunday afternoons color-coding spreadsheets like some sort of financial Monet. It tracks subscriptions so you never get ambushed by a forgotten free trial that morphed into a $14.99 monthly charge, and you can set flexible savings goals with progress tracking that keeps you motivated without being obnoxious about it. The app works seamlessly across iPhone, iPad, Mac, and their newly launched web app. And this is important to me, they're privacy first, meaning your data isn't being sold to the highest bidder. So if you've been meaning to get your financial life organized in 2026 without turning it into a part-time job, you can add 2 free months to your subscription with code Tyler when you sign up at try.copilot.money/Tyler. That's try.copilot.money/Tyler. Number 2, whole life insurance, aka the financial scam of the century. All right, Buttercup, buckle up. This is where we get into the weeds. And by weeds, I mean an industry that has spent over a century convincing people to buy a product that is objectively terrible for almost everyone who buys it. What is whole life insurance? Whole life insurance is a type of permanent life insurance. Unlike term life, which expires after a set number of years, whole life covers you for your entire life, hence the clever name. But it does more than that. Whole life policies also have what's known as a cash value component. A portion of your premium goes into a savings and/or investment account that can grow tax deferred. You could borrow against it, withdraw from it, or cash it out if you cancel the policy. Sounds great, right? Lifelong coverage and an investment account. What is not to love? Well, I'll tell you what's not to love. Whole life insurance is absurdly expensive. Returns on said investments and savings are notoriously terrible, and it's designed to benefit the insurance company and the agent selling it, not you. Let's break this down, starting with the cost. A healthy 30-year-old buying term life insurance with a $500,000 death benefit will pay about $40 per month. Now that same 30-year-old buying whole life insurance with the same death benefit, about $440 a month. That's 11 times more expensive. But Tyler, you say, that's because whole life builds cash value. You're not just paying for insurance, you're also investing. Well, start by remembering there's no such thing as insurance and investing. But sure, let's talk about that quote-unquote investment and the returns you get. The cash value in a whole life policy grows at a rate determined by the insurance company. Right now, most whole life policies offer around 4 or 5% annual returns on average. Now, they will sell you on the single highest rate they've ever offered and make you believe that you'll magically get more per year. You won't. If retail investors can't get more from the broad market, how on earth do you think they're going to give you more than the average market return and then cover you on the downside? Yeah, this is where you choose to take the red pill with me to see how far down the rabbit hole we want to go here. Compare that 4 to 5% just to the S&P 500, which has averaged about 10% annually over the long term and 7% in real terms. And for a 35-year-old, that's the only term we should be thinking about, the long term. Not one bad down year. So you're paying 11 times more for a product that grows half as quickly as a basic index fund. But wait, there's more. Let's talk about the break-even problem. When you buy a whole life policy, it can take years, sometimes even decades, before the cash value exceeds what you've paid in premiums. I reviewed a Northwestern Mutual whole life policy recently. Sorry to call you out directly, but if you're going to sell it, I'm going to critique it. It took 16 years before the cash value was greater than the total premiums paid. 16 years, and that's your own money. If you cancel before then, which most people do, you lose that money. You don't get your premiums back. You get whatever meager cash value has accumulated, which is often less than what you paid in. And here's yet another kick in the pants. About 25% of whole life policies are canceled within 3 years, probably because people woke up and saw they were bad ideas. And by 10 years, 40% are gone. The insurance company knows this. They're banking on it, literally. So, who benefits from whole life? Not you. Let me tell you who does benefit. The insurance company. They collect your premiums for years, invest them themselves like you should have, and if you cancel early, they keep the difference between what you paid and the tiny cash value you get back. Gosh, this is where I wish I'd gone into the insurance industry and become a CEO. My goodness, this is insane. Who else wins? The agent. Whole life policies pay massive commissions. The agent selling you a policy typically earns 100% of your first year's premium as a commission. So if you're paying $5,000 a year, the agent pockets $5,000 up front. So no wonder you've been told they're great. That's the sale. But let's keep going down the rabbit hole because it's story time. Here is the Northwestern Mutual actual playbook. If you haven't seen it, there's a recent article from The Guardian that I would encourage you to read. And it exposed how Northwestern Mutual, one of the largest and most quote-unquote respected life insurance companies in the country, recruits college students and recent graduates to sell whole life insurance. And here's how it works. Northwestern recruiters show up on college campuses with slick marketing. Join a Fortune 500 company. Become a financial advisor. Unlimited earning potential. Students apply, thinking they're getting a prestigious job in finance. But here's the catch. At the interview, they're handed a worksheet. The worksheet asks them to list 10 friends or family members, names, phone numbers, occupations, and each of those people to refer 10 more. It's not a job interview. It's a lead harvesting operation on mass scale. Again, it's genius. The students who get hired are told to upload at least 2 100 contacts into company software. Then they start dialing. 40 calls a day. Friends, cousins, roommates, anyone who might pick up the phone. The script? Hey, I just started this new job as a financial advisor, and I'd love to sit down and help you with your financial plan. And when someone agrees to meet, the quote-unquote financial plan that gets generated invariably recommends none other than whole life insurance, the single most expensive product every single time. One former intern described selling a whole life policy to his teenage brother, then being scolded for not making it expensive enough. Another was urged to buy a policy himself just to meet quota. And let me be so crystal clear. These aren't financial advisors regardless of what they decide to be called. They're insurance salespeople calling themselves advisors, and they're being coached to prey on their own friends and family. And on top of that, guess what? Most of these reps don't last. About 80% drop out within the first month because, they didn't sign up to be at a call center selling whole life to their 9-year-old kid sister. The ones who stay, they describe it as cult-like. One rep said, you really have to choose your Northwestern career over the friendships that you used to have. Another, most of your friends end up blocking your number. And here's the thing. These reps who stay, the ones who drink that delightful tasting Northwestern Kool-Aid, genuinely believe they're helping people. They've been trained, I could use some other words there, to think whole life is good for everyone. They've been told it's the foundation of every financial plan. Well, my friends, it's not. It's a bad product that benefits the company and the agent, not the customer. And as always, let's look at some quick math. Let's say you're 30 years old. You're deciding between term life and whole life. Option 1, we buy term life and invest the difference. The term life premium, $40 a month. The whole life premium, $440 a month. A difference of about $400 a month. If you take that $400 a month and invest it in a low-cost S&P 500 index fund earning 10% on average annually, after 30 years, you'd be projected to have about $900,000. Now, behind door or option number 2, if we had bought whole life, after 30 years, your cash value might be around $150,000, assuming you keep the policy the entire time and don't cancel. So, up to you. You could have $900,000 and have been covered, or you could have $150,000 and have been covered. But again, they'll sell you on the fact that during that 30-year window, the market went down a few times and they could have protected you on that downside as if that was when you needed the money. Whole life insurance is not an investment. It's a way to make insurance salespeople rich. That college roommate whose number you've blocked? Yeah, that's who you're making rich. So, who should buy whole life? There are exactly 2 scenarios where whole life might make sense. Number 1, you are ultra wealthy and you've maxed out every other tax-advantaged account. At that point, whole life can be a tax-efficient way to pass wealth to heirs because you can also fund the cash value way earlier and with more money. Number 2, you're using it for estate planning, and you have a team of CPAs and estate attorneys advising you on exactly how to use it. If you do not fall into one of those 2 categories, you don't need it, you don't want it, term is best, invest the rest. Number 3, the hybrid models, IULs and variable life. Okay. So we've established that whole life is terrible. Well, I've established that. But the insurance industry knows that people are catching on. I told you, they're smart. So they've come up with new products to sell you. Indexed universal life policies and variable universal life policies, IULs and VULs. These are marketed as better versions of whole life, more flexible, higher growth potential, all the benefits of insurance and investing. Just remember, there's no such thing as insurance and investing. And the truth, they're equally terrible. Let's start with what are IULs and VULs. Both are types of permanent life insurance with a cash value component like whole life, but instead of the insurance company deciding your returns, your cash value is tied to the performance of the stock market, in the case of a VUL, or an index like the S&P 500 for an IUL. Again, the companies usually can choose which index you're tied to. Sounds great. Again, right? Market-linked returns. Except, number one, you don't actually own the investments. You're not buying stocks. You're buying a product that tracks the return of the market, and it has caps and floors set by the insurance company. So if the S&P goes up 20% one year, your IUL might only get credit for 8% because there's a cap. If the market drops 20%, yeah, you might only lose 2% because there's a floor. Now, that sounds good until we remember that where we really make money in the stock market is by removing caps and experiencing and being exposed to the good years, as 75% of the time the market is higher in a year than it is today. So even though they're selling this downside risk protection, the real value in investing in the market is not having a cap on the good years. Those caps severely limit your upside. Number two, the fees are insane. IULs and VULs are packed with fees. Cost of insurance, administrative fees, fund management fees, surrender charges. These fees eat into your returns every single year and make paying an advisor 1% of your assets look like a great deal. And number three, they're even more complex than whole life, which means it's even easier for agents to sell you something you don't understand. And while we're at it, hate to say it, but I'm already going there, and it's true, many agents I know who sell these products do not understand what they are or how they work, but they've been told to sell them above everything else because they get the biggest commissions. If they can't explain something to you and they just keep saying, don't worry, we'll structure it properly, but they can't tell you what that means, run for the hills. Now, if you don't believe me, again, someone who's not trying to sell you any type of counter product on this, so I have no incentive to slam this just for the sake of slamming it. Even the insurance companies know these products are being missold and have tried, sparingly, to step in. Several major insurers have sent letters to their own agents telling them to stop marketing IULs and VULs as wealth building tools. Why? Because regulators were catching on. Agents were pitching these products as investments, not insurance, and that's a legal problem, especially as these agents weren't licensed to sell securities. But guess what? The agents kept selling them anyway because the commissions are huge and they're incentivized to say whatever will get you to buy. So, my take, if you want life insurance, buy term life, invest the difference. If you want to invest, open a Roth IRA or a taxable brokerage account and buy low-cost index funds. But do not mix insurance with investing. Insurance is insurance. Investing is investing. This episode is brought to you by Facet. Every January, we prioritize our physical health like it's New Year's resolution Olympics. New gym memberships, meal prep containers, apps tracking our sleep and hydration, or even dry January. We do it because we know physical health affects everything else. So let me ask you something. Why don't people give their financial health that same energy? I'm not talking about vague intentions like, this year I should probably save more. I'm talking about actually sitting down and asking, am I on track to retire when I want to? Am I leaving money on the table with my tax strategy? Do I have a coherent plan, or am I just throwing money in random accounts and hoping for the best? And I know this matters to all of you because I get hundreds of messages every week from readers and listeners asking me for advice. And I genuinely want to help. That's the entire reason I do this. But I can't give personalized advice. Your situation, your income, your goals, your tax bracket, your timeline, it's too specific for me to address responsibly in a podcast or newsletter. That's why I partner with Facet. With a Facet membership, you'll get a dedicated team of CFP professionals who build actual financial plans tailored to your life, not generic templates or product pitches. They charge a flat annual membership fee, not a percentage of your assets, which means their advice isn't tied to how much money they can get you to invest with them. You're already taking the time to optimize your body this month. Why not your finances? Facet is offering my listeners $250 into your brokerage account if you invest $5,000 within your first 90 days. Plus, the $250 enrollment fee will be waived for new annual members. So connect with Facet today at facet.com/Tyler and start 2026 with both your health and your wealth dialed in. That's facet.com/Tyler. Facet is an SEC registered investment advisor. This is not advice. All opinions are my own and not a guarantee of a similar outcome. I'm not a member of Facet. I have an incentive to endorse Facet as I have an ongoing fee-based contract for cash compensation, as well as a percentage of equity in Facet based on this endorsement. Number 4, annuities. Actually useful for some people. And I know they get a really bad rap, but let's talk about them. And before you groan, hear me out. As again, I'm not here to sell you annuities, but unlike whole life and IULs, annuities actually can serve a purpose for a greater percentage of people. What is an annuity? An annuity is also a contract with an insurance company. You give them a lump sum or make regular payments, and in exchange, they promise to pay you a steady income for a set period or for the rest of your life. There are a couple different types that you could look up: fixed annuities, variable annuities, immediate annuities, deferred annuities. But the basic concept is the same: guaranteed income for as long as you live. Who should consider these? Well, I think annuities make sense if you're extremely risk averse. You don't want to worry about market volatility at all, and you're willing to pay for the peace of mind of guaranteed income. Or you have a really long projected time horizon. If you're 65 and expect to live to 95, an annuity that pays out for 30 years could be a good hedge against running out of money, especially if you can't get long-term care. Finally, if you don't have enough assets to kind of self-insure. If you've got $10 million, you don't need an annuity. You can just live off your portfolio. But if you've got $500,000 and you're worried about outliving it, an annuity might make sense. But let's cover the downsides. Start with, again, high fees. Annuities are expensive, as the insurance company is taking on the risk of your living a wonderfully long and healthy life. And the longer you live, the more they lose. And management fees, surrender charges, rider fees, they do add up. So again, you're paying to have this guaranteed income. Next, a downside is complexity. There are so many types of annuities that it's easy to get sold the wrong one. And if you can't explain a rider fee in 10 seconds to a 10-year-old, not for you. Finally, illiquidity. Once you buy an annuity, your money's locked up in an annuity. If you need it back, you'll pay hefty surrender charges just to get out of the contract. So always consult an advisor before you make any of these choices, preferably one who isn't incentivized to sell whole life and isn't actually a financial advisor. My take: annuities aren't inherently bad, but they too are often missold, hence the bad rap. Number 5, long-term care insurance. Finally, let's talk about long-term care insurance, something many of you have asked about. Coverage for nursing homes, assisted living, or in-home care when you're older and can't take care of yourself. The problem: long-term care for many of us is so expensive. Average cost of a nursing home is over $100,000 a year. If you need care for 5 to 10 years, that's $500,000 to $1 million. And most people can't afford that out of pocket, and Medicare will not cover what you need. So, one solution, sort of, was long-term care insurance. It used to be the answer. You pay premiums, and if you need the care, the policy covers it. But here's the problem now. Most insurance companies don't even offer it anymore, as guess what? They weren't winning, aka the math didn't math for them. People are living longer than expected, and the claims are just way higher than insurers anticipated. So many companies either stopped selling it or jacked up the premiums to a point where it's unaffordable and doesn't actually make that much sense. Should you buy it? If you can get it while you're young-ish in your 50s and you anticipate a long lifespan and you don't have enough assets to self-insure, I'd consider it. But if you're already in your 60s or 70s, it's probably too expensive to be worth it, and you most likely would be better off investing that money. But as always, consult someone who doesn't just walk through the woods rambling about whole life. One last note for this week. If you do go the self-insurance route and you want to cover yourself with your own assets, you need to consider the health savings account if you have a high deductible health plan and you have the money to afford to put into one, because the HSA is the single best tax advantaged account in existence, period. Why? We've been over this. It's the only account with a triple tax advantage. Contributions can be tax deductible. The growth when you invest that money is tax free, and withdrawals for qualified medical expenses are tax free. No other account does this. Not your 401k, not your Roth IRA, just the HSA. If you're on a high deductible health plan, you can max this out every year, and starting in 2026, that's $4,400 for individuals and $8,750 for families. And if you're over 50, you can make another $1,000 contribution. Then, and this is the pro tip, don't use it now for healthcare if you can afford not to do so. Pay your medical expenses out of pocket if you can, and just let that HSA grow. It can grow because once you fund most of these, you can invest the money. And again, I'd choose a low-cost index that tracks the S&P or the total market. And after age 65, the HSA functions like a traditional IRA anyway. You could withdraw for any reason and just pay ordinary income tax, no penalty. But if you use it for qualified medical expenses, it's still tax-free. So, it's a retirement account disguised as a health account, and most people who have high deductible health plans are eligible for this account and can start funding today to give yourself your own annuity / cash balance / long-term care under your own control for much cheaper, aka for free. So, my take, if you have access to an HSA, max it out right now. It's one of the best financial moves you will ever make. Insurance is supposed to protect you from catastrophic financial loss. That's it. It's not an investment. It's not a wealth building tool. It's a cost you pay to transfer risk. And here's what you actually need. Term life insurance if anyone depends on your income. Disability insurance to protect your earning power if anyone depends on your income, including yourself. Health, auto, and homeowners insurance for catastrophic losses. And HSA contributions if you're on a high deductible plan. And here's what you don't need. Whole life insurance, unless you're extra wealthy and doing estate planning. IULs and VULs, they're whole life with extra complexity and fees. And annuities, unless you're extremely risk averse and have a long time horizon. The industry makes billions convincing people to buy products they don't need. So hopefully, I've moved the needle back just a little bit to convince you just to take one more look and to think about it one more time. And if this episode was helpful, please consider leaving a review on Apple Podcasts or Spotify. And if you've got questions or you want to tell me I'm wrong about something, or you work for an insurance company and already have your fiery retort ready to go, you can find me on Instagram or TikTok, and I'll do my best to offer some sassy responses depending on how you choose to engage and how I'm feeling on that particular day. Thanks for listening, and as always, hope this gives you something to think about throughout the week ahead. Thanks for tuning in to your Money Guide on the Side. If you enjoyed today's episode, be sure to visit my website at tylergardner.com for even more helpful resources and insights. And if you are interested in receiving some quick and actionable guidance each week, don't forget to sign up for my weekly newsletter, where each Sunday I share 3 actionable financial ideas to help you take control of your money and investments. You can find the sign-up link on my website, tylergardner.com, or on any of my socials at socialcapofficial. Until next time, I'm Tyler Gardner, your money guide on the side, and I truly hope this episode got you one step closer to where you need to be.